Hello and welcome to On the Money, a weekly look how to get the best out of your savings and investments. If you regularly listen to the podcast, you may have noticed that I've been away the last couple of weeks, but I have been keeping a close eye on the markets and how Donald Trump's tariffs are keeping investors on tenterhooks. It's great to be back, and I thought that given we've not covered on the podcast the recent stock market volatility, that we should dedicate an episode to it. But given there has been a lot of coverage already on why the sell-off has occurred, I wanted to instead mainly focus this episode on what we can learn from the sell-off, and indeed what we can learn from other stock market sell-offs that have taken place throughout history. I've also crunched some performance numbers to assess how different types of funds have fared during the sell-off. Joining me for this episode is Craig Rickman, personal finance editor at Interact Investor. For those that didn't see it, Craig, alongside three other internal experts at Interact Investor, participated in a webinar before the Easter bank holiday weekend that answered questions from customers about the stock market sell-off. I'll put a link to that webinar in the description of this week's episode. Craig, for those that didn't tune in, could you give a flavour of the sorts of questions that customers were asking about the sell-off?
Indeed, I can. So, there was a really interesting mix of questions. So, someone asked for advice other than not to panic. One asked, I get that markets have recovered from downturns in the past, but is this one different? Someone else asked, is a multi-asset fund all the diversification I need to protect myself through this period of volatility? Another asked, how can investors nearing retirement protect their portfolios during economic uncertainty? So, a real mixture of questions that captured what investors were thinking and feeling at the time.
And one of the key messages in answering those questions is the importance of keeping a cool head and not panicking. When stock markets become more volatile, as they have been, it's important to take the long-term view rather than make any rash decisions that you may later regret. Of course, a loss is only a loss when you sell. Until then, it's a paper loss, and there is the prospect of recovery. Now, at the worst point, which was on the 8th of April, the S&P 500 index had lost 20% of its value from its earlier all-time high, which was achieved on the 19th of February. And when a stock market index falls 20% or more, that is called a bear market. Meanwhile, the technology NASDAQ index, it lost at its worst point nearly a quarter of its value from its pre-Christmas peak. Now, since then, both the S&P 500 and the NASDAQ index, they've been making a partial recovery on the back of Donald Trump pressing the pause button on tariffs for 90 days, except, of course, for China. Now, Craig, I think it's also important to stress that while it is unnerving to see your investments fall in value, depending on where you are on your investment journey, stock market sell-offs can actually turn out to be great buying opportunities due to the fact that share prices fall and valuations also fall at the same time.
So, absolutely. And I think the big thing there is where you are in your investment journey. So, whether falling markets pose an opportunity or a threat largely depends on whether you're still in the process of accumulating wealth or you're taking an income from it or are close to taking an income from it. So, if you're still saving for retirement, for example, and you've got sort of many years on your side, if markets drop, you can buy shares at cheaper prices that when markets then recover at some point, which history tells us they do, can deliver a meaningful boost to your portfolio. But in contrast, if you're fast approaching retirement or are already drawing an income, volatile stock markets can be a bit of a worry, as you may have less scope to ride out the ups and the downs. That's one side to it. The other side is if you're in cashing shares in falling markets, then that can affect how quickly your money grows when the rebound does arrive. So it very much depends on where you are in your investment journey.
And at times such as these, when there is heightened levels of stock market volatility, I think it really tests your mentality as an investor. And if you are concerned that you may panic sell when stock markets fall on bad news, then it may be more suited to you to consider drip feeding money into the market rather than investing a lump sum. So if you have a regular plan say for instance, you invest at the start of every month, that does away with the risk that you may put all of your cash into the market just before a nasty dip. And so this strategy benefits from something that's known as pound cost averaging. So when stock markets fall, the regular investment purchases more shares or fund units. Conversely, when stock markets rise, fewer shares and fewer fund units are bought. Having said that, data does show that while there's no guarantees, of course, you could get your stock market timing terribly wrong, that if you do put lump sums into the market at the right time, when the market then goes on to have a buoyant period, then that does tend to beat regular investing. Now, while stock markets do look fragile in the short term due to the uncertainty over the unpredictability of Donald Trump's policies, which, as many column inches have already been written, stating that they could prove to be inflationary and harm both US and global economic growth, it is when stock markets sell off that investors are offered the opportunity to try and buy low, provided they're willing, of course, to accept the risk that things could get worse before they get better. Now, however you invest, whether you invest lump sums or you have a regular investment plan, it's important to stay disciplined and focus on your long-term goals. At times such as these, I think comfort can be drawn from the history books, which show that stock markets do tend to recover from sharp falls. So data from fund firm Mirabal Group shows that historically it has taken the S&P 500 index an average of 19 months to recover from a fall of 20% or more. And I've also seen separate data from fund firm Schroders that points to the fact that the global stock market falls 20% once every 4 years on average, and it falls 10% in most years. That may surprise you, but those are the statistics that show that the stock market does fall more often than you may think. As Schroders notes, the simple reality is that the stock market has tremendous power to help grow wealth in the long run, but short-term volatility and risk of falls are the price of the entry ticket. And the data that Schroders based that on was the MSCI World Index, and it looked over the last 53 years, and it found that 10% falls happened in 30 of those 53 years, whereas for falls of 20% or more, that happened in 13 of those years. I think that quote from Schroders is great because it reinforces the fact that at times of stock market turbulence, you've got to remember that volatility is par for the course of investing, and it is the price that investors pay for the fact that over the long run, putting your money in the stock market and investing it tends to deliver greater rewards than leaving it in cash. Craig, another investment fundamental which really comes to the fore when stock markets have a tricky period is the importance of being diversified, which is something we've spoken a lot about on this podcast over the years. And diversification, of course, involves owning a mixture of different asset classes and different fund types.
Yeah, diversification is a drum that's repeatedly beaten by journalists, investment experts, financial advisors. But I think, as you say, you only really notice its worth when things take a turn for the worst, even if it's a temporary blip. So yeah, the idea here is that you spread your portfolio across different asset classes, like shares, bonds, maybe commodities as well, gold. I mean, we know how well that's done recently. But also across different regions and sectors around the world. And the idea is that if one area is struggling and underperforming, others are there to support them. So it's really a way of spreading your risk. The familiar saying, don't put all your eggs in one basket. If you were to drop one basket and the eggs smash, you've still got other baskets and other eggs.
As you mentioned, Craig, we do talk a lot about the importance of diversification. So I thought, let's see how well diversified funds have performed during this period of stock market volatility. So I took a look at how funds fared since US stock markets started their descent, which was on the 19th of February. And I ran the data from that date to the 24th of April, and the figures are from FE Analytics. So over that period, firstly wanted to look at US funds. So the average US fund is down 16.2%. Now, US funds that are focused on US smaller companies, they've fared worse. They're down on average 20.3%. which is slightly higher than the average loss for technology funds, which are down 20.1%. And the average global fund is down 12.3%. Now let's have a look at funds that are more diversified than the funds I've just mentioned that invest in a single equity area or theme in the case of technology. So multi-asset funds, which invest in both shares and bonds, you'd expect them to be better equipped to weather a market storm versus the equity funds that invest globally or in one particular region. So there are investment association mixed investment sectors, which are multi-asset funds. So we looked at the two lower risk ones. So firstly, the investment association mixed investment 0 to 35% shares sector. Over that period, the average fund is down 2.3%. Now, moving up the risk level a notch, multi-asset funds with a bit more in equities, but plenty in bonds still. They've also limited losses. So the average fund in the investment association mixed investment 20 to 60% share sector is down 3.9%. Now, another renowned investment strategy is the 60-40 portfolio. So this is having 60% in shares and 40% in bonds. If you look over the past couple of decades, this has really served investors well, apart from in 2021 when interest rates rose significantly, which caused both shares and bonds to fall in tandem. Now, over this particular sell-off, a fund that follows this approach is the Vanguard Life Strategy 60% equity fund. And over that time period, it's down 5.6%. I think overall, multi-asset funds, they've held up very well during this sell-off, and the data proves that. Now, I also looked at performance numbers for a small number of wealth preservation investment trusts that prioritise protecting investor capital. So therefore, when there is a stock market sell-off, you'd expect these trusts to keep losses to a minimum. We've written many articles about these wealth preservation investment trusts over the years, and I've spoken a lot about them on various podcast episodes. So the three main ones are capital gearing, personal assets, and rougher investment company. So they all have a low weighting to equities, and they have lots of defensive assets, such as low risk inflation-linked bonds and some exposure to gold. Now, over this period, one of them actually made a small gain of 0.7%, and that is the rougher investment company. And both capital gearing and personal assets held up very well too. They limited losses to 0.9% and 0.7%. There are, of course, other options for investors looking for defensive exposure in a portfolio, such as money market funds or gold, or indeed a fund that offers broader commodity exposure. But Craig, in terms of risk and tolerance for risk, which I know you write a lot about, it is a personal decision. Now, Craig, you were, in a former life, a financial planner. So I think it'd be really useful for you to briefly talk through what people should be thinking about when they're trying to grasp risk versus reward when making their own investment decisions.
Yeah, I think there are two aspects to risk versus reward and risk tolerance. The first is what you're like as a person, or what your approach to risk is as a person. Are you someone who's typically cautious by nature? Are you someone who's sort of happy to take big risks, or are you somewhere in the middle? So that's the first bit to understand. The second bit is when to deviate from that level of risk for specific investment decisions. So when I would sit down with clients, we would go through, there would be a risk profiling process, which would involve quite a lot of conversation, also an electronic questionnaire. The electronic questionnaire would sort of kick out a risk profile that it thought was suitable for that individual. And that would generally be bunched into certain levels. So it could be you're someone who takes very low risks, low to medium, medium high, and high. So that's one side of it. But then with specific investment decisions, sometimes it can make sense to deviate from that. So I think a good one is saving for retirement. So talking to some younger investors, they would often very much describe themselves as lower risk or more cautious, and the questionnaire would support that. But then when it comes to retirement savings, if you've got sort of decades on your side, taking a belt and braces approach to investing can cause you a lot of harm. You've got plenty of time for your money to grow, plenty of time for your money to ride out the ups and downs. And so in that instance, it can make sense to take more risk than what you would naturally be comfortable with. So I think that's the really important thing to understand. And then I guess on the other side of that, you could have someone who's sort of sees himself as a bit of a risk taker, But if their investment time frame is short, so they may need the money in a couple of years' time, I don't know, for example, to pay for school fees, then they may take or want to take a more cautious approach and so look at safer investments as a result. So I think that's it. That's the two things, is understanding, firstly, what you're like as a person, and then thinking about the risk and reward for specific investment conditions, and time frame is quite a big factor there.
And of course, there's lots of articles that have been written on how risky is investing and how to define investment risk. For me, it all boils down to the fact that risk is the permanent loss of capital. And at times such as these, when you see the value of your investments fall, it is scary, of course. But if you take the long-term view, you're giving your investments the best opportunity to recover because you're giving them time. I wanted to end by pointing out that if you look back at all the major setbacks for stock markets in recent times, such as the financial crash, European debt crisis, Russian invasion of Ukraine, COVID-19 pandemic, stock markets recovered from all of those crises. Now, of course, we don't know the length of time it'll take markets to recover from Trump's tariffs. I'm not Mystic Meg, but if I was going to make my best guess, I would say that I do think it's going to take longer than it took stock markets to recover from the COVID-19 pandemic. Stock markets, they're always looking for a catalyst. And with the COVID-19 pandemic, when the vaccines were announced, that gave the stock markets the catalyst to recover. Whereas this time, I think there's a lot of uncertainty over the tariffs and what the policies will look like and how governments across the globe will respond to the tariffs, how they'll retaliate with their own countermeasures. I just think there's a lot more uncertainty over the shape and form the tariffs will take. And of course, the tariffs, they're here to stay. So I do think it'll be a more prolonged period of stock market volatility. However, my view is that if you're a long-term investor, there's no reason to panic or panic sell. However, I do think now is a good opportunity following this sell-off to do a spring clean of your portfolio, examine how the portfolio has performed over the past couple of months and indeed over the long term, and think about whether you've got enough of a defensive buffer to withstand a further sell-off or indeed a sell-off in the future that occurs for a completely different reason. If you own both global and US funds, I'll take a good look at them, take a good look under the bonnet at the underlying holdings to check that they are sufficiently different from one another. Given the fact that the US stock market accounts for around 70% of the global stock market, if you own, say, an S&P 500 index fund or ETF, and you also own a global index fund or ETF, then you're going to be gaining a lot of the same exposure, particularly given that the biggest holdings in both the US and global markets are those US technology giants, the so-called Magnificent Seven. To avoid potentially doubling up on the same exposure, you could look to maybe own an index fund alongside an actively managed fund that doesn't have that much exposure to the Magnificent Seven stocks. Among the options that our analysts like at Interact Investor are the Dodge & Cox Worldwide Global Stock Fund and also Fundsmith Equity, which is managed by the well-known investor Terry Smith. And just to give you a flavour of how these funds invest, so the Dodge & Cox Worldwide Global Stock Fund, it invests in value stocks. So as a result, the fund is trading on a cheaper valuation than the global stock market. And Fundsmith Equity, as mentioned, it's managed by Terry Smith. It invests in high-quality companies with strong competitive advantages, which are typically based on having significant intangible assets. Both those funds are underweight the Magnificent Seven stocks. They do have some exposure. In general, if you're invested in a global active fund, they will typically own a couple of the Magnificent Seven stocks, but they are unlikely to own all of them. And I think it's a very bold decision if a fund manager doesn't have any exposure to the Magnificent Seven, given the fact that those stocks account for around 20% of the MSCI World Index, which is an index that many global funds benchmark their performance against. So as a result of those stocks being such a big part of the index, they are difficult for active fund managers to completely ignore. Now, thanks to Craig, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. If you get a chance, leave a review or a rating in your podcast app too. We'd love to hear from you. You can join the conversation, ask questions, and tell us what you'd like to talk about via email on otm@ii.co.uk. And do check out our website, ii.co.uk, where you'll find more information and practical pointers on how to get the most out of your investments. And I'll see you next week.